A bond fund promising a 12% income target sounds like someone found a cheat code. Investment-grade corporate debt in the front, double-digit cash flow out the back, but there is no cheat code. There is an options machine bolted onto the bond portfolio, and this patient has been alive for only 100 days. Today, we are opening the machine before anybody mistakes a target for a guarantee. We are dissecting the Amplify LQD Investment Grade 12% Target Income ETF, ticker LQDM from Amplify. This is not a conventional corporate bond fund that simply collects interest and passes it along. It is a passively managed fixed-income ETF tracking the Bloomberg U.S. Investment Grade Corporate Bond 12% Income Covered Call Index. The basic raw material is investment-grade corporate debt. Then the strategy sells 1 week at-the-money call options around its bond exposure to pursue a targeted annualized income of 12%. Plain English, the bonds are the engine, but option premium is the turbocharger. Without that second component, the portfolio's ordinary bond income would not explain the stated target. That distinction matters because the fund is not offering a magical bond yield. It is converting part of the portfolio's possible future appreciation into cash today. That may appeal to an investor who values regular income, but it creates a different return pattern from simply owning an ordinary investment-grade bond fund. The product launched on April 20, 2026. That makes this less of a completed autopsy and more of an early examination. We can inspect the design, measure the first results, and identify the pressure points. What we cannot honestly do is pretend that a few months constitute a full market cycle test. This video is for research and education only. It is not financial, investment, tax, or legal advice, and it is not a recommendation to buy, sell, or hold any security. ETFs can lose value. Distribution amounts, yields, portfolio exposures, and tax treatment can change. Verify the current prospectus, shareholder reports, distribution notices, index methodology, and other official fund documents for yourself, and consult a qualified professional who understands your circumstances before making any financial decision. Let's check the vitals. This is a corporate bond ETF with monthly distributions and an expense ratio of 0.54%. Its assets under management are $3 million, so it is still a very small fund. Small size does not automatically mean a bad product, especially this soon after launch. Every ETF begins somewhere, but size affects the practical questions surrounding the investment, trading liquidity spreads, institutional participation, operating scale, and whether the issuer eventually decides the fund is commercially viable. The monthly payment schedule may look convenient for investors matching portfolio cash flow to recurring expenses. Just remember that payment frequency says nothing about economic quality. Receiving cash every month is not the same thing as earning a positive return every month. The cash can come from bond interest, option premium, realized gains, or potentially capital being returned to shareholders. The fee also deserves context. You are not paying only for a static pile of corporate bonds. You are paying for a rules-based package that combines fixed income exposure with recurring option transactions. Whether that package earns its keep will depend on what the option overlay adds after costs, what it gives up during favorable markets, and how well the portfolio preserves capital through less favorable ones. Because the fund is so new, even basic observations remain provisional. A small change in assets or a few additional payments could alter how the early record looks. Treat today's figures as the opening scene, not the final act. The current run rate is 12%. That is the figure to lead with because it annualizes the recent payment pace and asks a practical question. If payments repeat, what would a buyer today collect over a year? The latest distribution was 24 cents per share. The mechanical annualized rate based on that single payment is also 12%. Neither figure is a promise. Annualized takes a short observation and stretches it across a full year. It is a speedometer reading, not a reservation for future cash. Option premiums change with market volatility, bond prices move with interest rates and credit conditions, and fund distributions can be adjusted. The trailing 12-month yield is only 3%, but that does not mean the fund suddenly accelerated from a long period of weak payments. It has not existed for a full 12 months. That historical calculation includes a large span when the product had not yet launched, and therefore had no distributions to contribute. The gap is mostly a young fund measurement problem. This is a good example of why yield labels need an instruction manual. The trailing figure is incomplete history. The run rate is a forward-looking extrapolation. One understates the current cadence because the fund is new, the other assumes the cadence continues. Neither should be mistaken for guaranteed one-year outcome. The right response is not to choose whichever number looks more exciting. It is to understand what each one measures and wait for enough real payments to replace extrapolation with evidence. Time for the history, brief as it is. The first window distribution average is 25 cents per share, and the latest window average is also 25 cents. Across the paid rows, the trend is roughly stable. There is no documented collapse in the payout, but there is not enough history to declare it durable either. Only 3 distributions have been paid so far. Three observations can show that the fund has started near its intended pace. They cannot tell us how the payout behaves through a sustained bond rally, a credit scare, a volatility drought, or a sharp change in interest rate expectations. That missing variety matters because an options income portfolio lives in more than one weather system. Market volatility affects the premiums available. Changes in bond prices affect the underlying portfolio. Interest rate and credit conditions influence both the value of the assets and the investor demand for them. A useful distribution record needs seasons. We would want to see whether monthly cash remains reasonably consistent, whether special circumstances produce sudden changes, and whether the fund supports those payments without steadily weakening its capital base. For now, stability deserves limited credit. The payments have not shown an adverse direction in the available rows. The honest footnote is that the available rows barely fill a postcard. Now we examine the price and net asset value path. The latest NAV and price are $23.78 compared with a launch reference price of $24.97. The NAV return since inception is -5%, and the maximum drawdown is also -5%. That decline is real, but context is essential. The record covers an extremely short period. Bond funds can move when Treasury yields change, when corporate credit spreads widen or tighten, and when investors revise their expectations for growth, inflation, or central bank policy. The option overlay can change the shape of those moves, but it does not make the portfolio immune to them. The central question is whether this is ordinary early fluctuation or the beginning of a persistent pattern in which distributions arrive while the capital base weakens. We do not have enough evidence to answer that yet. NAV is where income products eventually reveal their quality. A payment can feel like profit because cash appears in the account, but a distribution is not created outside the fund's economics. When money leaves the portfolio, the shareholder needs enough interest, premium, or investment performance to compensate for it over time. A modest decline paired with cash payments may be perfectly tolerable if the combined result improves and the strategy behaves as designed. A recurring decline that consistently outruns the income would be a different diagnosis. This early path raises the question. It does not settle it. The maximum drawdown is also too young to serve as a serious risk boundary. The fund has not yet encountered enough different conditions for investors to assume that its worst historical decline resembles its worst plausible future decline. So far, we have a measurement of what happened, not a stress test certificate. Price alone is not the whole return story because shareholders have also received cash. Distributions since launch total 74 cents per share, including those payments. The simple distribution inclusive return since inception is -2%. That is better than the NAV result, which tells us the cash has offset part of the capital decline. It has not offset all of it. An investor evaluating the early record would therefore have received income while still finishing modestly behind on this simple measure. This is why total return belongs at the center of any income fund analysis. A brokerage statement may display each distribution as welcome cash, but wealth is the value still invested plus the cash removed from the account. Separating those two pieces can make an ordinary or negative result look more impressive than it really is. There is also a practical difference between spending the payments and reinvesting them. An investor using the cash for expenses locks in the income experience but leaves fewer dollars compounding inside the position. Someone reinvesting acquires additional shares, but remains exposed to the same fund mechanics and market risks. Neither choice transforms a weak strategy into a strong one. It only changes how the outcome is experienced. The current result is not disastrous and it is not proof of success. It is simply the first combined score from a very short game. Here is the machine under the hood. The official description says the portfolio invests through the LQDM ETF, while the index is built around investment-grade corporate bonds. No individual top holdings list was supplied in the data, so we should not pretend to know the exact issuers or weights. What we can identify is the exposure class, a diversified basket of higher quality corporate debt rather than a portfolio centered on stocks or speculative bonds. Against that exposure, the index sells at-the-money call options that expire in 1 week. At-the-money means the option strike is set near the current level of the underlying exposure. 1 week means the strategy repeatedly returns to the options market rather than locking in one long contract. When the fund sells a call, it collects premium from the buyer. That premium becomes a source of cash for the portfolio. In exchange, the buyer receives rights tied to gains above the options strike during the contract period. The fund is effectively saying, pay me now, and you may claim some of the upside if this bond exposure rises enough before the week ends. That creates the defining trade, income now in exchange for constrained upside later. Imagine corporate bonds rally because market interest rates fall or credit conditions improve. A plain bond position can participate directly in that price appreciation. This strategy may capture some of the move, but the short call can surrender gains beyond the strike. If the rally is fast enough, the option buyer benefits from upside that the fund agreed to sell. Now imagine the bond basket falls. The call premium supplies a cushion, but only a cushion. It does not place a concrete floor beneath the portfolio. A meaningful decline can overwhelm the premium, leaving shareholders with both a lower asset value and no guarantee that future payments will repair the damage. A quieter market creates another edge case. What should investors watch from here? First, build an actual distribution record. Several more months would show whether the early cadence is repeatable rather than merely a launch period pattern. Second, compare cumulative cash with the ongoing NAV path. The important question is not whether money arrives, but whether shareholders retain enough capital after it arrives. Third, inspect future distribution notices and tax documents. Watch how payments are characterized and whether return of capital becomes a recurring feature rather than an occasional accounting outcome. Fourth, follow the fund's asset growth and trading conditions. A larger, more established asset base could improve confidence in the product's staying power. Persistent small scale would keep closure risk and liquidity considerations on the table. Fifth, compare performance with an ordinary investment-grade corporate bond benchmark during different environments. If bonds rally, observe how much upside the calls surrender. If bonds fall, measure how much protection the premiums actually provide. If markets become quiet, see whether the payment level adjusts. Sixth, read the index methodology rather than relying on the fund's name. The rules governing option strikes, expirations, settlement, and rebalancing determine how the strategy behaves when markets move quickly. Finally, allow time to do its job. A product designed to produce recurring monthly income should be evaluated over enough monthly cycles to expose both its strengths and its compromises. Case still open. That is the verdict, word for word, because only 100 days and 3 distributions stand between launch and this examination. The early payout cadence is roughly stable. The cash has softened the decline in capital, and the total result is currently negative 2%. None of that is long enough to establish either a success story or a structural failure. The fund has a coherent purpose: turn investment-grade corporate bond exposure into a higher current income package by repeatedly selling short-dated upside. That can be a legitimate trade for the right investor. It is not a free enhancement, and the income target should never be confused with a guaranteed economic return. The encouraging sign is that the opening payments resemble the stated objective. The unresolved issue is whether the strategy can preserve enough shareholder value while continuing to make them. So the responsible conclusion is patience, not praise and not prosecution. Let the portfolio experience more than one market mood. Let the distribution history become a history. Then we can determine whether this machine is manufacturing sustainable income or merely presenting tomorrow's capital in a monthly envelope. 2 quick things before you go. If this teardown helped you see past the headline yield, hit the like button. It genuinely helps the channel. Subscribe so the next ETF autopsy lands in your feed. And drop a comment. Which ticker should we put on the table next, and where do you think the real risk is hiding? We read everyone. Thanks for watching.